Hello and welcome to another MyCP Insights. My name is Jason Dynison. I present a lot here at MyCPE One. You can hear me in the archives. I teach on a lot of different things, and periodically I do these MyCPE One Insights. So let's get started with a few interesting articles from the tax and accounting world over the last few weeks. So our first story is about the country of Oman in the Middle East. It is introducing an income tax, an individual income tax, not just for the first time in that country, but they are actually the first nation in the Gulf to introduce an income tax at all. These countries all rely on oil revenue. So, what's going on here? This is a personal income tax that will start in 2028. Now, it's supposed to only be assessed against the top 1% of earners in that country, which in Oman means about 109,000 US dollars. And the tax rate would be 5%. Deductions will be allowed for healthcare spending and charitable donations. So Oman is the first country in what's called the Gulf Cooperation Council to have an individual income tax. So Oman, Saudi Arabia, United Arab Emirates, Qatar, Bahrain, and Kuwait are the member countries, and none of them have ever had an individual income tax. They rely on oil revenue. Oman has been a magnet for expats and global businesses. Really, all of these countries have been. One thing that's not quite clear, I guess, is how this might affect the expats living in Oman. Now, oil revenue in Oman, that accounts for about 85% of their public income, so their government revenue. 85%. But the country is trying to hedge its bets a little on the up and down nature of oil prices, plus thinking long term in the decades to come. If oil revenue declines or the amount of oil that they can produce declines, they're looking for other revenue streams. We don't know what other countries in the Gulf will do, if they'll follow suit, but it has been said, including by the International Monetary Fund, that Gulf countries will eventually need to diversify their revenue streams to make up for potential decline in fossil fuel demand. There's also 1.8 million foreign workers in Oman, and expats and so forth, and depending on how this tax hits them, people might be looking at other countries to move to. We always like to highlight artificial intelligence news. So here's Meta. They've invested $15 billion in a company called Scale AI. So let's look at this. Meta has filed a lawsuit against an app as well. So it's been busy times recently for Meta. Meta is Facebook, or Facebook is Meta, Mark Zuckerberg. So Meta has purchased a 49% stake in a company called Scale AI. The company is valued at around $29 billion. So this is somewhere around $15 billion that Meta is investing in this purchase of this company. And so this company basically provides data sets that make generative AI models smarter, faster, and more accurate. ChatGPT is one example of a generative AI. So now Meta has access to these data sets. And so, what do we think Meta will do with this? Well, they have this AI model called Llama, which will now have access to better training data, hopefully closing the performance gap. That's what they hope with OpenAI, ChatGPT. Defense and government contracts, this Scale company already has contracts with the military for AI work. And Meta has just revealed what's called Defense Llama. So there's going to be collaboration, as the article says, far beyond social media. This is beyond Facebook. Meta does Facebook, but there's a lot of other things going on. Revenue-ready AI structure, so recommendations for ad targeting and so forth. Any way that they can monetize things. At the same time, Meta has filed a lawsuit against Crush AI, which is an app that created non-consensual AI-generated nude images and ran thousands of ads on Meta's platform. And the lawsuit accuses the parent company of this app of evading ad detection systems. So Meta has responded not just with the lawsuit, but by employing AI to basically get better at spotting and taking down things like this. Microsoft is also getting involved in this. They have a $13 billion stake in OpenAI, but there's a difference between what the two companies are trying to do. So Microsoft is looking more at how to integrate things like ChatGPT and other such models into their existing products, like the Office suite, Outlook, Excel, Word, all those. There's dozens actually of apps within the Outlook or the Office family. And then other offerings like the Bing search engine and Copilot and so forth. So integration with their existing suite of things that they already have. Whereas Meta is kind of investing in infrastructure, basically, and trying to build its own models and using data sets, from this Scale AI. Meta has also launched this VJEPA2. I'm honestly not sure how that's pronounced. It's spelled VJEPA2. That's how we'll pronounce it for now. That understands how objects move, fall, roll, and interact in physical space, which what does that mean? Well, it's delivery drones, self-driving cars, and augmented reality battlefield gear. What is augmented reality? That's like the glasses that you can put on that will give you information about your surroundings, and it's something that was it's been a part of like sci-fi movies and action adventure movies where you're looking at something and you see information about things around you. That's kind of a layman's definition, I guess. Also, ads have come to WhatsApp. 3 billion users are on WhatsApp, and basically they've all been monetized. Now into some tax, guess we could call this tax audits or tax justice, whatever you want to call it. That's what we'll close things out with. A $1.3 billion tax shelter fraud scheme involving a New Jersey CPA. And actually, there's others who have been busted in this. He's just the most recent one. So this CPA in New Jersey pleaded guilty to helping high-income clients take vastly inflated conservation easement deductions. And, you know, conservation easements are something that the IRS has been cracking down on. People have been taking advantage of this. So this was a nationwide scheme. It wasn't just this guy, but he was part of it. That promised basically for every dollar that people invested, they would get $4 back in tax deductions. And this guy's role was doing things like backdating checks and creating false tax returns, among other things. So conservation easements mean that someone owns land and they give up the development rights on the land in exchange for a charitable contribution deduction. This is legitimate, but the problem that happens with this stuff sometimes is inflated valuations on the land, resulting in inflated charitable contribution deductions. And there was this scheme that inflated land values by 30% to sometimes over 100%. And this company, I don't know if it was a company, but there was a Georgia-based CPA and an attorney who were among the organizers of this with the help of an appraiser. And they would pitch basically pay $100,000 and get $400,000 off your taxable income. So this New Jersey CPA faces up to 5 years in federal prison, plus restitution, supervised release, and monetary penalties. Now, the other two involved in this, the Georgia-based CPA and the attorney, have received prison sentences, one for 25 years and one of 23 years. So, I mean, this guy's punishment is much lighter, but I guess it just calls into play. If it seems too good to be true, it probably is. And it can be really easy to get drawn into these things because there's a lot of money involved. But if it's not legitimate, you know, the IRS is going to come calling, and in things like this, the Justice Department will get involved. Here's another scheme that came crashing down. This is a little different from some of the schemes that you hear about. This involved seemingly a regular old CPA, Christine Gendron, a CPA in Massachusetts, pleaded guilty to bank fraud that basically cheated lenders out of over $19 million. There were no offshore accounts. This wasn't some, you know, big nationwide scheme. This was a local, fairly small town sort of thing. So what happened is these family members, her sister and brother-in-law, owned dozens of LLCs that held commercial properties. And Gendron would falsify documents that were given to banks, making the banks think that all of these LLCs were cash flowing with their rental properties and making money, when some of these properties were not making money. The goal was to trick lenders into thinking that these properties were profitable and get loans. And you can see towards the middle of the screen here, when you add those numbers together, it's over $75 million. And this was done through inflated monthly rent payments and lease documents with forged signatures. And once the loan money would come in, the company, the LLCs, would stop paying or make minimal payments or default altogether, resulting in over $19 million in losses. And so, this CPA faces up to 30 years in prison and a fine of $1 million. The other two family members involved in this one of them faces sentencing this month, and the other one has a trial in the fall. And then one more story here about a dentist in Colorado who got busted in a tax fraud case. So what happened is that this dentist paid $50,000 for what the IRS calls an abusive trust tax shelter. And it's basically a fraudulent maze of shell entities. And so he created a business trust, a family trust, a charitable trust, and a private foundation, all under his control. He got friends to sign as the fake creators of these trusts and create the illusion that the funds belonged to those entities rather than him. Now, the thing on this story is he did apparently talk to some attorneys and CPAs that told him that Colorado law prohibits trusts from owning dental practices, but he went ahead and transferred ownership of his clinic to the business trust anyway. And he funneled more than $5 million in earnings into these entities that he formed. He kept control of them, and he would pull money out to pay for his lifestyle. Mortgages, credit cards, vacations, boats, season tickets to baseball, and he filed false tax returns for himself, his practice, and the trusts, claiming his personal expenses as either charitable deductions or trust-related costs. And at the end of the day, the government says it was about $1.5 million in tax loss. So he's been sentenced to 41 months in prison, 3 years of supervised release, a fine of $150,000, over $1.4 million in restitution to the IRS, and another 166, almost 167,000 to Colorado for their tax loss. Again, if it sounds too good to be legal, it probably is with taxes. Well, that'll do it for this round of MyCPE Insights. I'm Jason Dynison. Thank you so much for joining us, and we'll talk to you again soon.